Hey guys, welcome back to the channel. In this video, we're going to be going over the Invesco ETF QQQM. All right. So if you guys have any questions related to ETFs, investing, dividend stocks, maybe some real estate, please let me know down below in the comments. All right. This channel thrives on questions. I love answering questions and helping people build their portfolios. All right. So without further ado, let's get into the video. So like I said, this is going to be a overview of QQQM, which is the Invesco's ETF that tracks the NASDAQ 100. We're going to go over the ETF, and I'm going to give you guys some key metrics for that ETF. We're going to talk about the composition as well as the risks, and at the very end, I'm going to give you guys some tips for success. All right, so what exactly is the Invesco NASDAQ 100 ETF QQQM? All right, it is an ETF that invests in stocks of companies such as communication services, consumer discretionary, consumer staples, energy, healthcare, industrials, and info tech. All right, QQQ is a different ETF. So QQQM came out a couple of years ago, and basically at a very high level, the only difference between these two ETFs, QQQM and QQQ, the biggest difference is going to be the expense ratio. All right, where QQQM has a expense ratio of 0.015, QQQ has an expense ratio of 20 basis points. Okay, so just keep that in mind. All right, that's going to be pretty much the biggest difference between the two. But both ETFs track the same index. The underlying differences in its key metrics. All right, so this is the key metrics that I want to show you guys. So again, it hasn't been around for a very long time. Let me get my little red pen here. So it really started around here. It came out at probably like during the pandemic, when I remember it came out, and it made a lot of waves, because people were excited about this thing because it was, one, it's a cheaper product, and two, this is going to be more for the buy and hold type of investor, right? QQQ is also for the buy and hold type of investor, someone who has like a 5, 10, 15, 20, or even a 30-year kind of hold period. This one fits perfectly because the expense ratio is much lower. So looking at the expense ratio, it's 15 basis points. So again, QQQ is 20 basis points. So you're getting a 5% or a 5 basis point difference or a discount, which is nice. The dividend is fairly low. Again, this is a tech heavy type of ETF, so you're not really going to collect too much in dividends. It does pay it quarterly. And the other big one that we want to keep an eye on is the assets under management, right? AUM. So this currently has $38 billion in assets under management. Assets under management is basically investor money. So people like you, people like me, people like institutions, or probably other retail investors, right? They're putting their money into this. So having $38 billion is, it just shows that the ETF is very stable. Anything under probably like 100 million, I'm kind of iffy about. I don't really invest in ETFs that are that low. Not a recommendation, of course, do whatever fits your strategy, but I'm just saying, like, I personally don't have any ETFs that are under 100 million in assets under management. All right. So max, we could see it's 82%. So comparing QQQ to QQQM, and I'll do a video on this probably a little later, but QQQM has actually outperformed QQQ only by a small margin, and that is probably attributed to the lower expense ratio for the M ETF. All right, so that's this ETF at kind of a high level and what the metrics that we want to look at. So what are the holdings? So the holdings are actually almost identical to QQQ, okay? Again, this is a very tech-heavy ETF, and we can see that right here, right? You have almost 50%, well, actually almost 51% dedicated straight to technology stocks. And we can see the top 10 holdings. You have Apple, you have Nvidia, you have Microsoft, Amazon, Meta, Broadcom, Tesla, Costco's in there, Netflix, and Alphabet. Okay, so we know that this is a tech-heavy ETF, right? Because QQQ is also a tech-heavy ETF, and the NASDAQ 100 is primarily tech stocks. So we see this pretty good composition. You have 103 different companies in this ETF, so you're getting instant diversification, which is a great thing. So instead of purchasing 100 different companies, you can buy this one product, this one ETF, and all your money gets spread across 103 different companies. Now, the best thing about this is that, even if some of these companies perform really badly, the ETF is just going to kick them off and replace them with new ones. So you don't have to do any work, which is a huge, huge deal. So I would always recommend an opt, for ETFs for new investors, because it takes a lot of the guesswork out. It takes a lot of the, digging and deeper, analysis and trying to research, the individual stocks, or going through the financials and learning how to actually analyze stuff. So going with the ETF is always going to be, my recommendation. So, and we kind of already covered this piece, but, again, it's a tech heavy ETF. Since QQQM is a tech heavy ETF sitting at 50%, should the tech sector run into a correction or a pullback, the ETF price will be affected and could drop. And this is one of the risks of investing into, concentrated ETFs or thematic ETFs or even sector ETFs, because when that particular sector is affected, the ETF is obviously going to drop because all the companies in the ETF are affected. If you look at real estate, and if you look at VNQ, they've been pretty much pounded these last couple of years because, interest rates are high and all that stuff was affecting the real estate market. And then you have commercial loans that were just going crazy. You have commercial loans that are coming due, and it's like almost in it is in the billions. I think they had like $1 trillion worth of commercial real estate loans that were coming due in 2025 or something like that. So, they've been, there's a slogan out there called extend and forget. So they're, mortgage companies were just extending the debt and kind of forgetting it. But of course, that's kicking the can down the road for a bigger problem. Anyways, this is not a video about real estate. Let's get back to QQQM. So again, tech focused or sector focused ETFs, whenever that particular sector is affected, again, you will feel that pinch in your portfolio. And this is why it's so important to diversify. So market risks, QQQM is subject to macro market risks, which include economic downturns, interest rate changes, or geopolitical events that can affect certain stock prices or entire sectors. So again, interest rates, big deal. Over the last couple of years, although year to date, and if you look at kind of like how the performance of QQQ or tech stocks or even the S&P 500 have been doing, they've relatively been going up, but it's not to say it's always gone up, because there have been challenges, there have been corrections, there have been pullbacks throughout that entire time. So, right at the height of 2021, investor sentiment was very positive. Everyone was buying stocks, and then came the inevitable pullback when, there was talks about the Fed, increasing interest rates, that, inflation is not transitory. It's actually stuck in our economy, and we need to raise interest rates. So that's what ended up causing the whole stock market to kind of pull back. And so again, market risks, macro events, that can also affect ETFs. It doesn't matter if it has 100 stocks in it. It doesn't matter if it has 500 stocks. It doesn't even matter if it has 4,000 stocks. Macro events, geopolitical risk, things like that can affect the ETF because it's affecting the underlying companies in that ETF. All right. So, quick shout out again. I run a school on, or I run a community on School. It's called Invest Tribe. It's a community for new investors who are looking to learn. We discuss all things stocks and real estate. Learn how to build your wealth on autopilot. Link down below in the description. All right. So here's some tips for success. You should absolutely always consider diversification. All right. Since QQQM is a tech-heavy ETF sitting at 50%, should the tech sector run into a correction or a pullback, that ETF will be affected and could drop substantially. So you want to diversify, okay? There's always this talk that diversification is a free lunch, and it's easy to do. You can add an S&P 500 ETF, along with, QQQ or QQQM, probably like at a, I don't know, maybe like a 70-30, maybe like a 50-50 split between the two. It's really up to you. Or maybe you can make QQQM, maybe like 20 or 10% of the portfolio. It really all depends on like your risk tolerance and your time horizon. If you're probably nearing retirement, if you're up in that age group, you're probably not going to want to invest so much money into tech heavy ETFs, because again, you're gearing up for retirement. You're looking for more passive income. You just want to preserve the wealth that you built. So you don't want to be investing in like highly volatile, high risk type of ETFs or stocks. So if you're a younger investor, let's talk 18 to 34, and I say 34 because I'm 34. But 18 to 34, this would be perfect for you. All right, this would absolutely be perfect for you to start with, and just keep dollar cost averaging into it. And again, you want to diversify. You might want to throw in an ETF, another S&P 500 index in there, just to kind of balance some things out. Again, that is entirely up to you and how you want to handle that. So you want to absolutely control your emotions. This one's a big one. Even you want to control your emotions during the highs and definitely during the lows. All right, just because the ETF is going up, it doesn't mean that it's always going to go up and that you're some legendary investor that never loses money. If it drops, it creates a buying opportunity. Try to control your emotions. Don't sell and cement your losses. There's hundreds, probably thousands of examples out there in the world where people sold because they got scared. They didn't want to lose any more money, and only for the S&P 500 to recover, only for Bitcoin or cryptocurrency to recover, only for real estate to recover, right? So you want to be very careful. You want to control your emotions. Most times I find people get really scared because they don't have kind of the financial literacy, the education, right? They don't know the historical performance of that asset class, whatever they're investing in, whether it's stocks, bonds, real estate, cryptocurrency. They don't know the historical performance, right? So if you hold long enough, and if you look at how it's performed in the past, there's a better chance that it will recover. And the chances are increased when it's an ETF. All right. That doesn't mean all ETFs will recover. There's hundreds of examples of ETFs not recovering, but I'm saying the chances are much better. And if you sell, you absolutely cement those losses, meaning that you for sure are never going to get your money back, right? Instead, adopt the mindset that when these big market drops happen, that this is a buying opportunity, right? This creates a buying opportunity. There's opportunity in chaos and crisis. So always think about that when you're investing in the stock market. You always want to play the long game, all right? QQQM is subject to macro market risk, which can include economic downturns. Oh, actually, whoa. I'm sorry. I don't know how this ended up in there, but you want to play the long game. All right. Sorry for this error. I'm not going to edit this video because I try to do in one shoot. But anyways, play the long game. All right, guys. You want to have a 5, 10, 15, or 20, or even a 30-year lens when you're investing into these ETFs. Okay. This is a buy and hold long-term investment, and it's a passive investment. I mean, you don't have to do anything. You just keep putting money in every paycheck, every week, once a month, whatever you can, right? Try to increase that amount over time by lowering your expenses, getting a better job either professionally or within your career, getting promotions, getting raises, things like that. And just play the long game. Sit back, relax, and just watch your money grow and go to work for you every single day, okay? Because in that ETF, again, there's 100 companies that employ thousands and hundreds of thousands of people. And all those people are working hard every single day to make sure you, the shareholder, are getting shareholder value. So with that being said, guys, that'll do it for this video. I hope you guys got a lot of value. And again, I cannot stress this enough. Please, please, please let me know if there's anything I can answer for you, help you with. I make these videos around topics that my audience have questions on. All right. So I'll see you guys in the next video.